Too many business owners either overpay in taxes because they don't know what's available, or they get reckless advice on social media that sounds good but can land them in hot water with the IRS. Neither of those paths are where you want to be, and in today's episode, we are going to talk about business structure and write-offs that you can use legally and correctly in your business to save as much as possible on taxes. So let's get started. Hello, my name is Stephen Young, your host of the Savvy or Surrender podcast. And what we want to do is every Wednesday, we are coming to you with a new podcast episode in order to help your business get better and to strive to be savvy and not to surrender, because we never want to surrender our business. As you've probably heard, there's oftentimes people will say 50% of businesses don't make it more than 3 years. And I would say it's probably even more than that if you take into account all the smaller businesses that never really even get started. So the big issue is that business owners, let's talk about a plumber. They're a really good plumber, but they're not necessarily a really good business owner. And so when they start in business, they don't necessarily know all of the things that they need to know to become a good business owner. And so that's what we're here to do with the Savvy or Surrender podcast, is to provide some of that guidance, primarily in my specialty with the financial side. I'm a profit first professional with the book Profit First from Mike Michalowicz, available on Amazon. And actually today I just ordered 4 more copies here to add to my collection here. They're $9 right now on Amazon. So if you're listening to this podcast and you want to go check it out, if you haven't read that book, go check it out and see what deal you have going on right now with Amazon. This episode of the Savvy or Surrender podcast is brought to you by SavvyCEOAlliance.com. I've created a group of people coming together that are looking to be more savvy in their business. So go to SavvyCEOAlliance.com. You can find some different training modules. As I build it up, there's going to be more on profit first principles, tax strategies, marketing strategies. There's going to be monthly workshops. All of it is completely free. All you have to do is go to SavvyCEOAlliance.com and join there in the school community, and we will see you there. Really, in today's episode, my goal is to be able to help you understand over 30 tax write-offs, strategies that can save your business thousands of dollars this year. So if you're tired of writing massive checks to the IRS or have conflicting advice about what's deductible, this episode is going to be for you. Here's the problem with tax write-offs. There's so much misinformation floating around. You'll hear one person say, write off your whole car, and another person will say, don't do that, it's illegal. Or somebody will say, the vehicle has to be in the business name, and somebody else will say, no, it doesn't. It's okay if it's in the owner's name. Maybe business owners end up being confused because they either end up playing it too safe and they overpay in taxes to the IRS, never a good thing, or they push the envelope and they risk penalties and getting audited, and that's not a good thing either. So let's start from the very beginning. If we look at let's take that plumber who wants to become a business owner. Let's say it's a Friday evening. They just got done with work for the week. They're frustrated. Maybe they didn't like their pay. Maybe they don't like their boss. Maybe they don't like the hours or whatever it is. And they come home, they talk to their spouse, significant other, and they say, I think I'm going to start my own business. And so over the weekend, they kind of plan out some ideas, maybe a business name, and maybe they go look at how to register. They go on LegalZoom or something and pay way too much money to be able to go and do that, whatever it is. So let's say they decide they're going to start this business. Well, what entity structure should they be? They don't really know. They maybe do some quick research. Number one, you don't have to be any kind of special entity. You can literally be Stephen Young Plumbing, and that's it. And you're what's called a sole proprietor. There's nothing special about it. There's no tax incentives different from an LLC even. But you can just hang your shingle out and you're ready to be in business. So if you want to work on the side, if you want to just work on weekends, whatever it is, you can do so and not pay any money or get any kind of crazy structuring. Get insurance, get your license, you're good to go. The next type of entity, so you've got the sole proprietor, and then you can also become a partnership. If there's 2 or more of you, you automatically become a partnership. Whether you file for it or not, it doesn't matter. You're automatically a partnership. And then there's the next one, the most common one right now is an LLC. So an LLC stands for Legal Liability Company. Now, this is more of a state designation and more of a legal, thus the legal liability company. The idea is that you're transferring the liability of your business in the event there's a big claim, in the event something happens. You're transferring the liability to that company, to that entity, and taking it off of you personally. Now, here's the problem with that. If you don't do everything you're required to do legally, the whole purpose of getting an LLC is for naught. Like it doesn't actually happen. So for example, if you commingle funds between your business account and your personal account, in the event of a big lawsuit, a lawyer is going to pierce the veil. They're going to be able to see through that entity structure and they're going to be able to come after you personally. If you don't maintain your board meeting minutes and have board meetings, or maintain your operating agreement, or follow your operating agreement, or even have an operating agreement, those are all things that you need to be doing if you have an LLC or some other type of business entity. You have to maintain that structure. Otherwise, in the event of a big lawsuit or any kind of a lawsuit, the lawyer is going to be able to pierce that veil and they're going to be able to come after you. So none of those are good situations. Tax-wise, an LLC is called a disregarded entity, meaning the IRS doesn't care that you are an LLC. You still get taxed on your personal tax return. You'll have what's called a Schedule C. That's for your business expenses. You'll have that whether you are a sole proprietor or an LLC. Doesn't change anything. Your taxes are still due on April 15th, or if you do an extension, on October 15th. Now, the next one is a C-Corp or a corporation. So that's when you see Inc. at the end of your name. So if I'm Stephen Young Plumbing Inc., that means I am incorporated and I'm automatically a C Corp. Without changing any designation, I'm automatically what's called a C Corporation. Now, the downside to a C Corp, number one, you do now have a separate tax entity. The IRS recognizes a corporation, and you do have to file what's called an 1120. You have to file a separate tax return. That tax return is due on March 15th. By the way, if you're a partnership with 2 or more partners, you're also due on March 15th because that is a separate tax return that has to get filed as well. Let's stick to the corporation though. So you're a corporation, due March 15th. If you can do an extension, or if you do an extension, then that goes to September 15th. On a C Corp, you have to pay the corporate tax rate, which is currently 21%. So the corporation pays 21%. You have to take wages as an employee. I'm no longer the owner of the business. I might be a shareholder, but I'm not the owner of the business. I'm a shareholder and an employee. I have to have a wage, so I have to have a W-2. Any additional profits that I take from that business then are going to be considered basically dividends from those shares of stock. And then I pay the capital gains tax on those dividends on my personal return. For the business return, you pay the 21% corporate tax rate on that business. So now I've got a business return, I've got a personal return. Whatever deductions, tax credits, things like that I take on the business, that's separate from the business and the personal. On the personal, I'm going to get my W-2, and then I'll also see what I get on the dividends and have to deal with those. Now, the option exists, and you've probably heard it on social media, that you can become an S-Corp. An S-Corp can be off of either a C-Corp, so you can start off as Stephen Young Plumbing, Inc., and then you can designate from a C-Corp. You can say, no, I want to be an S-Corp. Same thing with an LLC. I can be Stephen Young Plumbing, LLC, and then be taxed as an S-Corp. You have to file Form 2553. You're supposed to do it within 75 days beginning of the year, of your calendar year or your tax year. So by March 15th, you're supposed to have that Form 2553 filled out. Now, you can backdate it 2 years. There's usually some rules there, but the IRS generally accepts it. And throughout the year, you can still get them accepted. You just have to put on the form that, I'm sorry, this is late. This is why. And you have to give a reason. You sign it in a couple spots, fill it out. It's pretty simple to do. You can fax it to them, you can mail it to them, whatever, and they'll get back to you and say, hey, this has been approved or this has been declined and here's why. They generally get approved. It's not really that big of a deal. Okay, so now we have a separate tax return due March 15th. We have an 1120S for the S-Corp. So we have to complete that tax return. And then again, due March 15th, you'll get what's called a K1. That's kind of like the W-2 for the business. So that K1, so you'll have your W-2 from your wages, because remember, that's a separate entity. You as the owner are now an employee. You have to be on wages. So that's one of the challenges of being an S-Corp. I generally do not recommend becoming an S-Corp until you're making at least $50,000 net in the business, because there's some additional expenses to being an S-Corp that it doesn't really make sense to be one until you're making enough money that it helps. And we'll talk about why you might want to be an S-Corp in a minute. Okay, so we've got that K1 and the W-2 gets issued. That tax return gets done March 15th. You do your personal return on April 15th. Now in your personal return, if you don't have any other businesses, there is no more Schedule C. You've got your W-2, you've got your K1 that you put on there, and that's your personal return. So your personal return's a little easier. That 1120S, that S-Corp return is a little more complicated. So they're generally more expensive, which is why, again, you want to make sure you're making at least $50,000 net. You can go a little bit lower than that, but for the most part, we're looking at about $50,000 is what I typically tell my clients. Okay, so why become an S-Corp? Because of a couple reasons. One, statistically, from what I have heard and seen, they get audited less than if you are just an LLC or a sole proprietor and you're putting all your expenses on the Schedule C with a personal return on the 1040. So that could be one reason why. The other reason is because now we're able to save money on the self-employment tax. So the self-employment tax is your Social Security and your Medicare, totals 15.3%. If you were an employee of Joe Schmo Plumbing, and you're getting a W-2 from them, you are automatically paying 7.65% of your wages in Social Security and Medicare, up to certain limits, but let's just say that's what we're paying, is 7.65%. When you're a business owner, and then the business owner, Joe Schmo, he's also paying 7.65%. So you pay half, he pays half. On top of that, you also have your federal withholding, and depending on what state you're in, you have your state withholding as well. So there's the state withholding, federal withholding, Medicare, Social Security, unemployment, things like that the business owner has to pay, but let's focus on those 4 items, okay? So the FICA taxes is the Social Security and Medicare. Again, 7.65% for the employee, 7.65% for the owner. So when you are the owner of the business, you get to pay both. So it comes out to a total of 15.3%. If you're a sole proprietor or an LLC, you pay that on everything, on all your wages. If you make $100,000 as an LLC, that $100,000 is going to be charged to you, and you pay $15,300 in self-employment tax, and then federal tax, and then state tax. When you are an S-Corp, and now you have to take a wage or a W-2. Remember, as an LLC, you don't take a W-2. You are not a W-2'd employee of this business. You're just simply a sole owner of the business. LLC, sole proprietor, doesn't matter. You're not taking a wage. You're not taking a paid check. So all of it gets taxed. S-Corp, we take a wage. Now, what is that wage? The IRS tells us that it needs to be reasonable compensation. What does that mean? We don't really know. They don't define what a reasonable wage is. So we have to kind of figure it out for us. Now, there's software that you can do that can kind of figure it out for you. But at the end of the day, what it really means is we need to figure out how much you should be paying yourself in wages versus how much you should be paying yourself in distributions. So for the wages side, you'll see some things on social media that maybe will say 50%. 50% of the business income should be paid out in wages, and then 50% of it should be paid out in the distributions. That really just depends. It depends on what the business is doing. If you're making $100,000 in net income, $50,000 in wages or 50%, $50,000 might make sense. If you're making $1 million in wages or in net income, $500,000 in wages, that 50% doesn't make sense anymore. So it's not a linear thing. It's not 50% no matter what. So you need to be able to look at that. You need to talk to a professional to figure out what your wage should be. But let's just go with, let's say we're going to get taxed. We made $100,000 in business. And so we're going to take a wage of $50,000 or $48,000. Maybe it's, $12,000 every quarter that we get reported. Now, you don't have to do a true paycheck like a employee would. You don't have to get a check every other week or every week if you're in the trades. A lot of trades still get paid weekly. So you don't have to do it that way. It doesn't have to be that rigid. It can be if that's what you choose to do. Say you want to continue to feel like an employee. You can go ahead and still continue to get a regular paycheck every week, every 2 weeks, once a month, whatever it is. I have business owners that do that. But you can also, at the end of the quarter, because the IRS likes to get their taxes quarterly, at least. So at the end of every quarter, you could go to your payroll provider. And I'm not sponsored by any of them, so you can choose the best one. You can use QuickBooks, Gusto, OnPay, Sure Payroll. There's several of them that are out there that you can use. But let's just say you use one of them and you go to them and you say, okay, I want to take $12,000 in wages this quarter. They will essentially write you a paper check, right? Not really write you a check for the payroll, but they're going to pull those taxes out and then they'll send that to the government on what's called a Form 941 for the federal at least. And then depending on your state, if you have state taxes too, they'll file those as well. So that's where it works, is that you'll have the wages taken out at least quarterly, and then they'll file those forms, or you'll file that form to the IRS to pull out those wages for the Social Security and the Medicare and your federal withholding. Now, the other half, your distributions. Let's talk about that now, because now we're only paying, instead of being a sole proprietor where we paid $100,000 in wages, or we paid out $100,000 in profits, I should say, and so 15.3% or $15,300 came out. Now, as an employee of the S-Corp, now we're only doing $50,000 in wages. We pay the Social Security and Medicare on it, 7.65%. So let's just call it roughly $7,500. Those distributions, we only get taxed at the federal withholding and the state withholding. We don't have to pay the FICA taxes. We don't have to pay Social Security and Medicare, that 15.3%. So we're saving that money. So essentially, by becoming an S-Corp, in this scenario, you're saving $7,500. That's what's going to pay the payroll costs for getting all that set up, and it's going to pay your additional filing fees for having to file for an S-Corp. Now, there's no taxes due on an S-Corp return. It's an informational return only. Some states like Idaho, they charge $20. California, they charge $800 for an S-Corp return. So it depends on the state, but federally, you don't have to pay any additional money. It's just a informational return that they send out. Now, you do want to make sure that either you get this done by March 15th or you do an extension. Even though there's no money due on the S-Corp return, you don't want to delay it, because the penalty is $205 per month per owner. So you can get hit with some pretty stiff penalties. And you can get those abated and all that kind of stuff, but you don't want to deal with it, right? You want to make sure you stay on time on those, or get the extension done. The extension is you're able to do that, and you don't have to pay any money on the S-Corp return because there's no potential taxes due on the S-Corp. It all comes over to the personal, to the owner of the business. So if you're Stephen Young Plumbing, LLC, taxes and S-Corp, I've got a $50,000 wage that I paid my Social Security, my Medicare on, federal taxes are withheld, state taxes are withheld. I have those distributions. I'm going to get a K-1 from my 1120S tax return, and I'm going to pull that over into my personal return as well, and I'm going to get taxed on that. Doesn't matter how much the business made. As an S-Corp, I'm going to get taxed on all of the income there. So if I made $1 million and I pulled out $100,000 in wages, I've got another $900,000 in a K-1 that's coming through that I'm going to have to pay federal and state withholding on it. So that's the entity structuring and how the tax part of it works. Now let's get into some quick deductions. Now, some of the things that we can think of: home office deduction, mileage versus actual expenses on your rental cars, business meals. Some of these things you just need to think of where you should be maybe reclassifying it. For an example, let's say you decide to sponsor your kids' baseball team. Is this a charitable contribution or is it a marketing expense? One of them gets pushed down to the personal return, and the other one can be a business expense. If you are simply reclassifying it as marketing, if you get your name put on everybody's shirt, that's advertising. You're able to kind of change or reclassify where that expense goes. So we just need to look at that. Home office deduction. You absolutely can take a home office deduction. It does not increase your audit risk. If you're a plumber and you're working out of your house, you have a home office that you can look at taking, as well as if you're using your garage or shop for business purposes, especially exclusive for business purposes, then you can write that shop off or that part of the garage off as well that you're using for supplies or your truck, or that's where your business is ran out of. You can do it all there as well. Now, business meals, you only get to write off 50% of it. But is it marketing? Is it a meal? What are you doing there? Are you getting coffee and doing a one-on-one? If you're buying meals for the entire crew for a meeting, that's written off 100%. You're able to, so make sure you get those classified correctly. And then there's bigger strategies that can save you thousands and thousands of dollars. So for example, hiring your kids. They're inside of the IRS code. It says that if your kids are under the age of 18 as a sole proprietor or an LLC, you're allowed to hire your kids and not pay the Social Security and Medicare. And then if you pay them less than the standard deduction, $15,000 this year, you don't have to pay anything there for the taxes as well. So you're able to just essentially write off your kids. Now, you can put them on W-2. There's some different schools of thought here, whether you just call them an outside laborer or contractor, or you could put them on W-2. The benefit of putting them on W-2, you still don't pay any of the taxes, but if you put them on as an actual employee in the W-2, now they've earned a wage and you can set up a Roth IRA for them and you can start saving them for retirement. As an outside laborer, you just simply pay them, you put it into their account to make sure that they're actually doing the wage or doing the work and that you're paying them the going wage for that work. So if they're coming in and they're cleaning the carpets and, vacuuming and they're filing paperwork or shredding some paperwork or something like that, that you're paying them the wage that you would pay for that type of work. You don't want to be paying them $100 an hour. That is going to be a red flag. You want them to actually be doing the work, and you want to actually transfer the money to their account. So you may need to open a bank account for them. That is how I have my son pay for his Taekwondo lessons. So essentially, I write off my son's Taekwondo lessons by having him come into my office. He comes in every Saturday before we go to Taekwondo. He comes in, he cleans, he does some work. I pay him for that work, and then he's able to, from his bank account, pays for his Taekwondo lessons. So essentially, I've written off Taekwondo completely legally. Now, once you become an S-Corp, it's a little bit different. You, as an S-Corp, that hiring your kids strategy changes a little bit, and you have to set up a family management company, which is subject for maybe another podcast episode rather than getting into all of that. And I can expand on that hiring your kids strategy as well. Retirement contributions, another strategy there. If you have additional money available, getting a solo 401k, SEP IRA, simple IRA, things like that. Health insurance and HSA deductions, as well as an HRA or health reimbursement account. Look into what a health reimbursement account can do for you as an employee. If you're an S-Corp, it changes a little bit because 2% of what you pay in health insurance has to go towards your W-2. So if you're more than a 2% shareholder, I should say, anything that you pay towards health insurance gets added on to your wages. So there's not as big of a benefit, but maybe you have your spouse be an employee and you have the health reimbursement account on your spouse. So there's ways that you can do it. You just have to make sure you follow the rules. If you're a real estate owner or investor, you've got cost segregation that we can look at as well. And then we talked about the S-Corp elections, reasonable compensation, Section 199A with a QBI deduction. That's the qualified business income deduction, which changed a little bit with the One Big Beautiful Bill. So you have that opportunity to save some 20% there as well. And then bonus depreciation in section 179 for equipment purchases. So if I'm that plumber, I'm buying a big backhoe, let's say, because I'm doing a lot of water main installation and I've got to pay 100 grand for this backhoe or 200 grand. Now I'm able to write that off 100%. I can take $200,000 automatically off of my earned income off of that, because now, so my business, instead of making $500,000 or $1 million this year, I've got that $200,000 deduction there. And then we've got some other more advanced strategies, things like the Augusta Rule that you've probably heard about, where you're renting your home to your business. So if you have a separate office, you're able to then use your business for, let's say, your tailgate meetings, for safety meetings. You rent out your house and you're able to write that off up to 14 days per calendar year. And then accountable plans for reimbursing yourself tax-free for things like the use of your car. So let's talk about that one real quick. Technically speaking, if you're an S-Corp and you own your vehicle personally, you're not able to deduct it and to write it off and depreciate it and do all those things, because the business doesn't own the car, right? You can't write off what you don't own. But as the business owner, you can set up an accountable plan and get reimbursed for those costs for the car. And then there's R&D credits, research and development credits, which again, the One Big Beautiful Bill expanded on that as well. And you can use that to, if you qualify, to be able to write off some of the costs there. And then you've got energy credits for solar, EVs, charging stations. Some of those, again, are changing with the One Big Beautiful Bill. You have, though, commercially until at least December 31st, 2026. If you notice something here, every one of these strategies have rules. They're powerful, but only if you apply them correctly. And so that's why it's not about memorizing a big list of write-offs. It's more about knowing which one fits your business and how to use them legally. I go in through a lot more detail of each one of these strategies in the SavvyCEOalliance.com. So take a look at that. And with that, I look forward to talking to you on the next episode.